morning and welcome to NYSE Live. I'm Ashley Mastronardi. Markets are fractionally higher following the release of the delayed January CPI report, giving investors a fresh look into the state of inflation. We'll dive into the figures investors are paying most attention to from the report in just a moment. Traders are also monitoring the latest developments across artificial intelligence after concerns over disruptions dragged down the major averages on Thursday. Here's what else is on tap this hour. Once Upon a Farm, which includes Jennifer Gardner as one of its co-founders, rang the opening bell to celebrate its IPO on the NYSE last week. Our very own Kristen Scholler sat down with CEO John Foraker, who shared why he felt now was the perfect time to go public. Meanwhile, tomorrow is Valentine's Day, and it's not too late to get your significant other something special. The owner of Lilac Chocolate tells us which items are flying off the shelves this year. And at 9:30 Eastern, NYSE-listed BlackRock, which is the world's largest asset manager, will ring the opening bell as the firm celebrates Black History Month. Just over 30 minutes ago, the Bureau of Labor Statistics released the delayed January CPI report, giving investors a fresh glimpse into the state of inflation. Here's what we learned. Headline CPI came in a tick below economist estimates, showing growth of 2.4% on a year-over-year basis and 0.2% on a month-over-month basis. Core CPI, which excludes the volatile food and energy sectors, increased at 2.5% on an annual basis. That was in line with economists' expectations. Joining me now to break down the data and everything moving markets is Frank Capillari, founder and president of Cap Thesis. Frank, welcome to NYSE Live.
Thanks so much, Ashley. A pleasure to be with you today.
All right, so what are you taking away from today's CPI data?
Well, I think it was kind of the best case scenario the market was looking for, especially after the jobs data a few days ago. And so I think looking forward, the Fed continues to be data dependent, but it still keeps two cuts on the table. And if you think about it from an economic standpoint, this is kind of the best case scenario. You want to see jobs continue. You want to see inflation contained. Now, the thing is, there's other places we can look for inflation data. And what I'm looking at are the charts of commodities, and they're continuing to move higher. So that just brings back memories of 2020 and 21. Remember, we saw crude oil start to move and a lot other as well, where the Fed remained on the transitory, view of inflation. Of course, that changed and they had to play catch up. So that's the concern, is if this inflation continues to move higher from a commodity standpoint, it will eventually move into the rest of the economy.
All right, and how should investors be pricing in this latest inflation data coupled with the January jobs report that came out this week?
Right, I think we're back to neutral in terms of what we can look forward to. The concern was, of course, a hot number today, which would have pushed cuts way further into the year, maybe if not at all. So I think that's off the table right now. And there's probably concern about that, with yesterday's sell-off as well.
Speaking of yesterday's sell-off, we did see a pullback in the markets yesterday. What do you attribute that to?
Well, of course, it is AI related, and some of those stocks really got hit hard. But if you think about it, other areas get hit hard as well that really aren't related to AI, gold and silver especially. And I look at those two, there are commodities based, but they're more or less momentum trades, from my perspective. So there are a lot of players involved with that, like CTA, big firms are just trend following firms like that, the trading firms, that will get involved in anything as long as moving higher or lower by a good clip. So when there's any sort of little movement like that, sometimes momentum really takes over and you see some big moves to the downside as well.
And the S&P 500 is entering today near the bottom of its 6-week range. What patterns are you seeing and where do you feel we go from here?
That's a great question. And I base my analysis at Cap Thesis on pattern structure. And so for the long time, we're looking at the S&P is trying to break out through the 6880 zone, get back to above 7,000. And what you can see through the end of the year of last year was a pretty substantial bullish formation in play. We've seen multiple attempts breaking out from that, just hasn't gotten there. So the concern is that buyers just get impatient because we've seen, the market react well on multi-day, multi-week basis, but what we're used to seeing from the previous number of months was buying breakouts, instantly rewarded, and the market goes higher. So if they get impatient, that means that they'll be more apt to sell the next downturn. So there's a kind of an air pocket of light support underneath that down to say 6,600, 6,500, where it was trading in November when we had that 6% pullback. So if we lose this area, I think that's at risk.
We did see the S&P hit or touch 7,000. What do you think? Do you think it's going to be there soon? What are your thoughts?
Well, it's shown the ability to get back up there, but what we need to happen for that zone to actually get busted through, we need large cap tech to participate in a much more aggressive way than we've seen that. If you look at the Mag 7 overall, it's kind of been a rotation within there. We haven't seen all 7 stocks moving up in unison really since October. And if you see that last part of October there, the end of the earnings season, there were some very good reactions. The S&P 500, the XLK, the Mag 7 ETF, all gapped higher, and that was it, right? And so we look at those bigger names, especially the ETFs that hold a lot of them, they haven't been back to the highs now in almost 4 months. The good thing is that we've had enough breadth. The foundation has been very strong. Just seen over 100 stocks in the S&P 500 make new highs 3 separate days in the last 7 days. That's strong. That hadn't happened since November of 2024. So there's a weird economy going on where the biggest names are participating. There's been so much participation underneath the surface that's allowed the S&P to at least stay near 7,000. And
what does today's CPI data mean for the 10-year Treasury yield?
Well, it's ticking lower, and I think that the big line in the sand there is 4.2%. If you go back almost 2 years, it has oscillated around that zone for a long time. So I think, obviously you think that there's going to be a tailwind for equities if the 10-year moves lower. I think that's true if the dollar falls as well, because we've seen over now, going back to at least 2022, and both of them are moving lower, tends to do well for the S&P 500. Growth stocks can outperform as well. But the most important thing, I think, from a 10-year perspective, is that it continues to remain quiet, right? It ticked higher to 4.2% for the first time back in late 2022, 2023. So we've been flat overall since that point. The best thing that the bond market can do from an equity perspective is remain directionless, and we've seen how that's worked over the last 2 years.
In our last minute together, what sectors are you seeing investors right now position themselves toward?
Well, again, there's been rotation. We've seen industrials take off, materials, consumer staples. And so those are almost getting too stretched now to continue at the pace that they are. So I think I'm always looking for budding patterns. And from a long-term perspective, even though energy has done the best, it's still maybe just getting started. If you look at now compared to, say, 2022, or even before that, 2021, energy started to outperform the S&P 500, and the S&P was still able to do well, even though energy was there. There was not until the very end of that run that energy was moving higher and S&P fell. So I think energy stocks, I'm looking for bullish patterns to develop in that. And one other area, again, kind of growth related, but not as much as technology, is communication services. So the XLC ETF still remains in this trading range it's been in for the last number of months. Always look for a compression of volatility like that to precede potential breakout.
Great. Thank you, Frank Capillari, founder and president of CapThesis, for joining us at the New York Stock Exchange.
Thanks so much, Ashley.
Coming up, the CEO of Once Upon a Farm told our Kristen Scholler that he sees a very big opportunity for the firm following its recent NYSE listing. Hear what else he had to say next.
As we stand on the cusp of America's 250th anniversary, we're reminded of the principles that have powered the world's greatest economy.
The New York Stock Exchange is a cathedral of the capital markets, replete with rhythms and rituals that allocate resources towards socially valued uses. That story will reach a rare milestone when our republic marks its 250th year. Anniversaries of this magnitude demand more than just ceremony. They ask something of us. They invite us to reflect, to ensure that the future that we shape will prove to be worthy of the legacy that we've inherited.
As a mom back in 2013, I didn't have the option to find any refrigerated kids food on the market, and today I can go into almost any store in the US. We literally have changed the entire baby food industry.
You guys have been there since literally the very beginning, and I'm so appreciative for you. You deserve everything that happens today.
And mostly just to all of these little kids who inspire us and make us want to build a better world, and we're doing it. We're actually doing it.
Welcome back to NYSE Live. 1 week ago today, children's nutrition company Once Upon a Farm made plenty of noise when it celebrated its IPO and began trading on the New York Stock Exchange. In fact, shares of OFRM popped by 17% in its first session. Our Kristen Scholler sat down with the company's co-founder and CEO, John Foraker, who explained why now was the perfect time to go public. Take a listen.
Well, our business has grown for a long time. Jen Garner and I joined this little company when it was really tiny about 8.5 years ago with a mission to drive systemic change in childhood nutrition for a happier, healthier, and more equitable world. And that mission has been something we've been focused on all this time, and we've built a significant company now. We feel like our market opportunity ahead is very, very big. It's a 50, kids and baby food in the US is a 50 billion plus category. And we're a leading brand in what we do, and we just think there's lots of places to play, and it feels like a great catapult for us as a business to take it public.
Let's talk more about the founding story behind Once Upon a Farm. You mentioned your co-founder, actress Jennifer Gardner.
Right.
How did this come about?
Well, I had been an investor in this tiny company, Once Upon a Farm, right after it started, and helping Ari and Cassandra, the two original founders. And Jen was interested in this business because she has a long history with Save the Children and really wanting to do something in the food space. And she saw that I was an investor. I was running a company called Annie's at the time, which was also a public company. And she said, hey, I need to meet this guy. And so we got together, and I was a half hour late for an hour meeting and of traffic and everything. But we bonded on mission and like, how do we drive better food choices for all children? And we had a like, I'm in if you're in kind of moment at the end, handshake. And the rest is history. We're all here. We've been growing this business together with a great team since then.
Your stock popped at the open. We're sitting down on the same day that the Dow has surpassed 50,000 for the first time ever. What does success look like to you?
Well, first of all, that's an amazing thing, that 50,000 and our company going public. Success looks for us like just that we continue to build a much bigger business. We continue to build distribution. We make these products available broadly to all consumers who are interested in better, healthier food for their babies and kids. And we're going to do that by just continuing to do what we've been doing, building a great brand, building distribution, great tasting products that consumers love.
You've been talking a lot about the market opportunities. Is there any more that you can share as our viewers can now follow your publicly traded stock at the ticker symbol OFRM?
Sure. So the baby food category is an interesting thing. It has historically been shelf stable. Products are heat treated and cooked, and they're on the shelf, and they have a very long shelf life. We're putting baby coolers in baby aisles, and the baby cooler allows us to have refrigeration so that our products that we make using just fresh, organic, incredible raw materials, fruits and vegetables, and we blend them up. We pressure process them at 40 degrees, and then they come out and they've got this amazing product. Tastes like you made it in your kitchen. 30 days later, it tastes like you made it in your blender. And that stuff is available now in grocery stores all over the country, and increasingly a lot more. That's just one fun thing we're doing, but we're building it out. We're building this brand out from babies to kids to be parents' ally. A trusted brand that they can bring in with babies' first foods all the way up to the kids about age 12.
How are consumer trends informing the decisions that you make as CEO of Once Upon a Farm?
Yeah, so they're very important. We follow those trends very carefully. We stay very close to consumers and empathetic and talking to them about what are the challenges they're facing. But consumer trends around functionality, wanting product to do better for them, protein, fiber, immunity, all these things are very important, and we're embedding those into our products. And most importantly, just making sure that the products taste great, They don't have any added sugar. So all of the sugars are coming from naturally occurring sources of real fruits and vegetables. These things and simple ingredients are what consumers are telling us they want. And so we're just continuing to do that across lots of different categories.
When it comes to innovation, what can we expect in the pipeline?
I can't give you the exact things. I can tell you that we have a lot of innovation coming into our baby coolers, more assortment, great functionality and need states that we can serve. And then also we're building the brand out in kids snacking, like Lunchbox. Think of being a parent's ally in that big challenge of packing a lunch for your child in the morning or having a really healthy afternoon snack when they come back from school. We're trying to meet those moments for our consumers.
Thanks, John Foraker and Kristen Scholler for that interview. And speaking of food, Fuda, which brings fresh local restaurant meals to workplaces, was among companies that participated in the 28th annual ICR conference in Florida last month. Its founder and CEO, Orazio Buzza, shared more details about the work it's doing and how it's shifted its strategy over the past few years. Take a listen.
We started primarily with mid-sized locations at around 500 people plus with what we call our pop-up program, where a restaurant comes on site and every day a new restaurant comes. And so that restaurant goes somewhere else. And then over the years, as we've grown, we've added group delivery programs to be able to address small and mid-sized populations. And then now we operate even full-blown cafeterias. Think large corporate campuses, hospitals, where there's 4,000 or 5,000 people plus at a location.
All right, and we definitely saw a shift in the pandemic. People were not working in the office. There was a big move to work from home or hybrid work environments. How did the business have to shift and evolve since that time?
Absolutely, yeah. So first of all, we believe that hybrid work is here to stay. And so even though we've seen populations at work, shift up over the last couple of years, long term, we're assuming that there's going to be some form of hybrid. Regarding how it shifted in the last 4 or 5 years, one is that I think before the pandemic, a lot of companies thought of on-site amenities and food programs as a way to focus on productivity, reasons to have people not leave the office. Now it's a tool to have people come back into the office. So think the concept is earning the commute for those on-site days. And as part of that, it's really important for companies to have a compelling offering. And for us, that means making sure that we're working with great restaurant brands, authentic food, a great consumer experience that wants to make people come back in the office. So net, it just become more strategic. And for a lot of industries, food programs now are table stakes.
And you work with some pretty well-known companies. Can you tell us who you work with and how you support them?
Absolutely. So we work with about 2,500 clients across the country. And regardless of industry, we work with all kinds of industry and locations types, everything from corporations to hospital groups, government, military, industrial facilities. And so regardless of the type of company you are, you're interested in employee recruitment, retention, and engagement. And so as part of that, we're helping companies roll out these programs across their portfolio of locations. And so that means having a consistent offering. That means making sure that they're proud of the restaurants and the food that they're serving to their employees. The kinds of companies we work for are everything from really large, call it Fortune 500 companies like Amazon, SpaceX, Southwest Airlines, some of the largest hospital groups across the country. But regardless of who you are, you're working with Fuda because you're looking to provide consistent offering across your locations at scale, and we can do that.
You're talking about being consistent, and when you're scaling at that level and giving or providing that much food, how do you maintain quality?
Absolutely. So we have a whole quality assurance program that restaurants have to go through as part of our onboarding process. And that includes everything from visiting their locations, managing and looking over their menu. Once they are live, we track a lot of QA statistics like getting there on time. Consumers are able to rate the food and provide feedback so we can manage, and make sure that the restaurants that provide the best quality continue to stay on our platform and provide that feedback when help is needed.
What do the logistics look like? Because it sounds like you're delivering a lot of food. How much food are you delivering And how do you make sure that it gets managed and delivered?
Well, we're at scale at this point. We passed over $1 billion in our lifetime of sales on our platform about a year ago, and we're going to hit about $1.5 billion at some point in the next 3 or 4 months. So it's thousands and thousands and thousands of meals, per day. But most of the logistical execution is being done by the restaurants. So Fuda does not generally touch the food. We're empowering the restaurants on our network to be able to execute, and our software helps them do that. Everything from providing visibility way in advance in terms of where they need to go, helps them with not only logistics but procurement. They can use our tool to help schedule their teams. Our software is also AI enabled, and we use AI to be able to predict what the sales are going to be at any given site at any given day. And so restaurants receive that information. They know how much to cook of what items on their menu so that they can optimize the opportunity.
Thanks, Orazio Buzzer, for that interview. And we are not done talking about food just yet. Coming up, the owner of Lilac Chocolates joins me here in studio to show off some treats flying off the shelves. You see them right there on your screen ahead of Valentine's Day. Stick around.
The New York Stock Exchange is a cathedral of the capital markets. So there are a few places more fitting to consider the future of the American financial system than this one.
At the NYSE, we applaud SEC Chairman Atkins and the entire Trump administration for working to reduce the burdens on existing public companies and soon-to-be public companies.
I believe that we will ensure that the American story, which began in many ways just steps outside, is preserved not by memory or speeches alone, but by the courage of those who are determined to chart its next chapter.
When we talk about the titans of industry and we talk about the titans of finance, there's a reason that we're all coming together still after all these years to the corner of Wall and Broad Street.
We are ringing the opening bell this morning to celebrate the launch of 6 new ETFs by Direction.
We look forward to many more. Today's 6, we're going to do hundreds more.
The New York Stock Exchange, the home of ETFs.
Welcome back to NYSE Live. Lilac bills itself as Manhattan's oldest chocolate house, making handmade chocolate since 1923. They currently have 7 New York City locations. Over the past century, the business has passed through generations of dedicated owners, and joining me now is one of them. Chris Taylor is the owner of Lilac Chocolates. Chris, welcome to the New York Stock Exchange.
Thank you for having me.
You have a very rich brand history. Can you walk us through the past 100 plus years?
Well, I wasn't alive 103 years ago, but the founder was a Greek immigrant. He came to America after World War I, opened up a little store on Christopher Street in the West Village, and the chocolate was just amazing. We were a customer for 20 years, and then somehow we ended up buying the company. And it's been a fun experience.
How did that happen that you were a customer there and you now own the company that has 7 locations?
One of my partners said, I want to buy that company. And I jokingly said to him, you just want to eat the inventory. But he persisted. And 3 years later, he ended up buying the company. And I sort of got dragged into it. I was just a finance guy. And it turned out to be an amazing experience, best experience of my life.
And speaking of wanting to eat the inventory, you have brought some chocolate today. Valentine's Day is coming up. Tell us what you brought.
Valentine's Day is all about truffles. So why don't you open it and taste it and tell me what you think?
Amazing.
And then this, different boxes for different flavors, but it's all about truffles and strawberries.
And how do you make the chocolates, and where are they made?
They're made in Brooklyn at Industry City, handmade, hand poured, and then they're packaged. We put more effort into the packaging than we do into the making of the chocolate. The making of the chocolate is an incredibly precise artisanal skill, but the packaging is just as important, especially for Valentine's.
And what kinds of broader trends are you seeing in the chocolate industry right now?
It's been a pretty brutal 18 months or so. Chocolate prices quadrupled, or really more than quadrupled. They went from $2,500 a ton to $12,000 a ton. Now they're back down to $4,000 a ton. And then, last year the tariffs hit us really hard because, packaging, everything is important. So it's not been a fun year for the chocolate industry, but you just sort of deal with it, and this year is looking a lot better.
And how much is the average consumer spending this Valentine's Day?
The typical ticket is probably close to $100. There's people that buy $20, $30, and then there's people that buy $200. But the average is probably close to $100.
And who do you see buying more chocolate? Is it men, women? Who do you...
2 weeks before Valentine's, it's 80-90% women. They buy gifts for family, for children, for teachers. And 2 days before Valentine's, or today, it's 80% men.
And it's very rare in New York City for a local business to be around for 100 years. What does that feel like to carry on that legacy of the founder of Lilac Chocolates?
It's been tough. It's not been an easy environment for retail in New York the last 10, 15 years, but it's also very satisfying because you get a lot of local credibility, respect, whatever you want to call it. So, you just got to deal with the challenges. A few years ago, we debated, are we going to move to Pennsylvania? It's going to be a lot cheaper. We can save a lot on labor, rents, all that stuff. But we decided we just want to stay in New York. We're New York's oldest chocolate company, and you just deal with it.
And how did you expand to 7 New York City locations?
It sort of happened by accident. We had the packaging, and I'm the finance guy. I thought it was a waste of money, but my partners decided to spend money on packaging. And then we actually introduced the new gift boxes the week of Hurricane Sandy, which was a logistical nightmare. And our sales doubled that Christmas. And I became a total convert. I said, okay, packaging is where we need to put our money. We invest in we're in the gifting business, and when you're in the gifting business, you are in the packaging business. And we invest an extreme amount of time in getting the packaging right, and then we invest a ridiculous amount of time in getting the chocolates right.
And do customers comment on the intricate packaging?
Well, let me tell you, we introduced the new Continental, and we spent a lot of time. It was dairy, 100% vegan, 100% natural, new fruits, new nuts, and we were just incredibly proud of the contents. And then this Christmas, as I'm in the stores talking to customers, they buy it because of the box. I was, very grateful because it was a huge hit for us. But on the other hand, I was incredibly annoyed because I'm like, we put all this effort into the contents, into the chocolate, and you're buying it for the packaging because you left the gift box.
All right, Chris Taylor, owner of Lilac Chocolates, thank you so much for joining us at the New York Stock Exchange. And in just a moment, BlackRock is going to ring the opening bell to celebrate Black History Month. We are going to go up to the podium to see them up there. Let's hear the opening bell.
16 years ago, an anonymous person released an idea onto the internet. No identity, no institution behind it, no marketing strategy. It was just a white paper and a challenge to everything we thought about money. What if money were open instead of closed? What if it belonged to everyone instead of being controlled by a few? Bitcoin survived every attempt to kill it because the idea itself was stronger than the forces that tried to stop it. And now, today, inside one of the most iconic institutions in the world of finance, we honor a creator who never asked for credit, never stood in front of cameras, and ultimately stepped away so that the idea could stand on its own. Satoshi Nakamoto.
Why are we here? Because Magnum Ice Cream Company is an ambitious company. We're all about growth. And for growth, you need people and you need to have belief that focus on only ice cream will propel this business. These folks here in the room wake up every morning thinking about ice cream, and they go to bed thinking about ice cream, and that's why it will be a successful company that delights the world with unbelievable products.
Welcome back to NYSE Live. Markets are officially open for trade and the major averages are fractionally lower following the latest CPI report. Joining me now is Ben Emmons, founder and CIO at FedWatch Advisors. Ben, welcome to the New York Stock Exchange.
Thank you, Essie. Good morning.
All right, so what should we be taking away from today's CPI data?
Well, it was actually surprisingly a little softer than what normally a January report has shown last 4 years. That was a bit of a downside surprise for the markets in terms of the good thing, right? Yields were a bit lower, stocks a little higher, a lot of energy effect there and some shelter and some specifics. But by and large, an inflation report that at least shows like maybe we're going to continue softening from here, depending how energy plays out. So good news, I guess, because we had a good jobs report. Now we're getting a softer CPI report. So good news. Probably okay for the markets.
That's right. We are coming off of a hotter than expected jobs report that dropped on Wednesday. What should our viewers know about the state of the economy?
So it is a good economy. I don't think there's any weakness. We're seeing this tension in the markets on AI and people worried about disruption, but the economy itself doesn't show the disruption. Even the jobs report, which had all these revisions in there, which were very large last year, downward revisions, that has actually nothing to do with AI. It's actually just not much hiring because of probably the tariff uncertainty that weighs the most on companies' decisions, but also a labor market that's full employed, most of it. So you get this picture of like having an unemployment rate close to 4% and inflation near 2%, then you have an economy that's actually trucking quite well.
And what do this week's jobs numbers and today's CPI data mean for the Fed's rate cut timeline? How do you see them using this data?
They have a little bit of time now because in March they probably can skip it again because of where we are currently. There's not so much of a pressure about inflation is declining a lot more and the Fed should cut rates, otherwise they get too tight in policy, or this jobs report is weakening too quickly, therefore we have to act. These dynamics are not playing right now, so I think that keeps the Fed on hold in March. April we'll see, because that's always a bit further away. And we're still dealing with the overhang of how Powell will leave the Fed and that sort of thing. That does play a little bit of a role, why the market thinks that there will be only rate cuts after the new Fed chair comes in the committee. So I think the Fed's on hold for the time being.
All right, and the next Fed decision is still over a month away. What do you think is the biggest item that can influence that decision?
Well, I think we already actually had that biggest item, which is the labor market. I think if the unemployment rate had moved up a lot, like say 4.6 or 7, then it would be a really different situation. So At the same time, this Fed is also looking at like what's happening globally, what's happening elsewhere, because we have not just a good economy here, but there's strength elsewhere. And there's some still worry within the Fed that inflation may resurge again at some point. So far not playing out, but that's the worry. So I think the Fed's sort of sitting here on their hands saying, we just don't want to bring this rate down too far, even below the neutral rate, because that may overstimulate the economy.
What do you see for Fed rate cuts in 2026? Do you think we'll see one?
I'm actually still in the camp that it will probably be 2, but that's really based upon if the unemployment rate stays stable where it is and inflation does moderate from here, then there's a little room there to cut. Otherwise, there's not much more than that. So what the Fed has already been saying, they think they're closer to where the neutral rate is, which they think is somewhere around 3.5%, give or take. My guess is that that's where we end for the time being. The bigger question will be is that as the new Fed chair comes in with this hidden mandate, so to speak, as in I rather got to bring rates lower, right? What will actually happen? Will this FOMC sway because of the political pressure? That's to be seen. We'll see what plays out there. I don't believe that actually. I actually think the Fed will continue to stay focused on data, focus on a collegial, like a consensus decision making, which leads you then to just moderate rate cuts. So you can only think potentially 2, and that's it.
And AI has been causing some choppiness in the markets. Why do you feel that is?
So it's notable because we had actually Microsoft first with a bit of miss on the cloud earnings, and that's when it started. And people started looking at Microsoft as the bellwether of like you're the software, and what will AI do? Now we know that the post by Anthropic with Claude on how to use that as a basically a tool to automate taxes or automate other sort of functions or automate software functions that sparked the anxiety. And I think what will then happen is you do have a lot of technical factors actually in the market of like, there's a lot of like these short-term momentum players that are, I think, playing these stocks really quickly and drive up the narrative. And now it has sort of started to spill over, right? We saw yesterday commercial real estate getting hit by it. Now the CBRE CEO, Solentic, did say like, well, if the labor force gets disrupted by AI, the demand for offices could change, could be negative. So there's something about this macro factor in the story. Is AI so disruptive to the labor market that it has these macroeconomic outcomes? I think that's what the market's trying to figure out. But I have to say that Treasury yields, they have declined, but I would have expected to decline them far more rapidly if there was a negative macro outcome from AI. I don't think that's the case. There's still much more spending and investment happening. It's just business models probably have to adjust. Like we saw in the 90s, we saw in the 2010s when new technology gets implemented.
All right, thank you, Ben Emmons, founder and CIO at FedWatch Advisors, for joining us and for your insights.
You're very welcome.
Coming up, fintech platform MoonPay just joined forces with Deal to help implement salary payments in a way you may not have seen before. We're going to have that story coming up.
I'm just so honored and so grateful to you, Lynn, for welcoming us to announce our Time Person of the Year, the architects of AI. I want to take a moment to welcome Chris Lehane. You have been an incredible driving force, making AI accessible to everyone, and we are so glad that you are here with us today. We are focusing on the leaders and the people and the humans that are imagining and building this future that we will all be living in.
We had somebody ask us recently, why are you going out at this time of the year? The reason we're doing this is for our people. It's not about us. Our motivation for doing this transaction is to make this a better place for the next generation. We have a stewardship responsibility to our people to give them a professional and a financial opportunity that's better than what we have. And what I am very proud of is the team that we have here. This is a true partnership in every sense of the word.
Welcome back to NYSE Live. Earlier this week, fintech platform MoonPay announced a new partnership with Deal that it says will allow for salary payouts to be completed with stablecoins. MoonPay adds that this offers a faster and more flexible way to get paid. Joining me now is Caroline Pham, MoonPay's Chief Legal Officer and Chief Administrative Officer, and she was previously the acting chair of the CFTC. Caroline, welcome.
Hi, Ashley. It's so great to be here. Thank you.
So great to have you. Can you share a little bit more about the service that MoonPay is providing and this new partnership with Deal?
Sure, of course. So we're very excited to announce this partnership with Deal, which enables cross-border payroll payouts. That means employees can opt in to be paid in stablecoins, and some of the benefits of that, especially from a cross-border perspective, are instant settlement, and you have it available right away.
All right, and how will it work if I'm an employee and I want to receive stablecoin for payment?
Sure, of course. So it's through the Deal payroll platform. And as an employee, you opt in. It's being offered in the UK and the EU to start, and then we'll be rolling it out to additional markets after that.
All right, and I understand you've announced 8 partnerships this year so far. Can you give us a breakdown of the other exciting news?
Of course. So I think 2026, like I said, is really the year of institutional adoption. It's the year that we start to see some of these commercial use cases actually go live, because last year we finally had the regulatory clarity that was necessary, especially from the SEC with their token taxonomy, to enable some of these partnerships to launch. So just a couple examples of the partnerships that we've launched since the beginning of the year. We have, of course, sponsored the X Games League, which is super exciting, and we're going to have the exclusive there for crypto, fintech, and payment providing. We also have announced that we're powering the Rumble wallet. And just yesterday, we announced the Telegram wallet. So you can imagine that all of the users, the creators that are on Rumble, everybody who's using Telegram, you can now send crypto, send stablecoins through your wallet that seamlessly.
All right, and I understand you started this role right in the beginning of January. You were former acting chair of the CFTC. How did that role prepare you for your role at MoonPay, and what are you exactly focusing on at MoonPay?
Of course. So with my background at Citigroup, where I was a senior banking executive across a lot of different dimensions, both institutional and consumer businesses, and involved in digital asset strategy across the firm, including as head of market structure, going to the CFTC, I was able to use my real world experience, hands-on experience building digital asset products and services to then make sure that we had policies in place, right? US crypto policy that would enable the actual use and adoption of crypto assets to modernize our payments and financial market infrastructure. So then, having worked both in the private sector and in the public sector, it's been great for me to bring my background in banking, payments, and markets to MoonPay, because really MoonPay's value proposition is that we are the trusted, compliant, global infrastructure partner to regulated financial services firms that enables access to the digital asset ecosystem. So look, it's 2026, it's first quarter. What is every investor, every board of directors is asking right now? What is our digital asset strategy? And if you're some of the largest firms, you have been working on your digital asset products and services, maybe in-house solutions that you've been building since maybe 2018, 2019. But most people haven't had the luxury of dedicating that much OpEx for a day that may never come, for regulatory clarity that may fail to materialize. And so now, what is your digital asset strategy? How do you turn on access to the millions of people worldwide who use crypto, who use stablecoins, who are crypto native and want to have that as their form factor? That's where MoonPay comes in, because we provide white label global infrastructure, and that's why we're excited to do things like powering the Rumble wallet, like powering the Telegram wallet, and we have more partnerships to be announcing this year as well.
All right, and in our last minute together, how difficult is it for a digital asset crypto company to stay regulated?
So look, the rules are the rules, and I think in the payment space that's been pretty well settled for quite some time now. MoonPay really prides itself on being one of the first to really take that compliance-first approach. We have 47 money transmitter licenses across the United States. We have the New York BIT license. We have the New York DFS Trust Company. We have licenses all over the rest of the world in the UK, the EU, and Australia. And I think having that compliance-first approach and having a robust risk management program in place is really what differentiates those digital asset services firms.
All right, thank you, Caroline Pham, MoonPay's Chief Legal Officer and Chief Administrative Officer, for joining us at the New York Stock Exchange.
Thank you for having me.
In other news, Return Pro is working with retailers and brands to solve the challenge of returns by addressing every part of the post-purchase experience. The company's CFO, Sam Mukherjee, was at last month's ICR conference in Orlando, Florida, and he told me just how significant this issue is. Take a listen.
Recently, NRF kind of published their survey. This is the National Retail Foundation, and it's an $850 billion problem in the industry. And on an average, the returns rate is 15% higher for e-commerce, which is like 20% or higher, or like 10 to 12% for things that you buy in a brick and mortar store. So therefore, it's a significant part. So anytime there is the consumers are buying it, a piece of that technically can be returned. And therefore, it's a huge problem for the industry. And especially now that e-commerce is becoming a bigger part of the retail mix, the growth of returns continues because it's, for things that you're buying online, there is a higher chance of you returning that product if you don't like it or the size is not correct. So it's definitely a significant problem for the industry. Having said that, in the past, it was a smaller issue for retailers, but today, because of this growth of returns, it's becoming more of an area of strategic importance for big brands and retailers to solve, because not only it can have a financial impact for you, and I can explain that later, but more importantly, it enhances customer experience. Same survey that actually NRF published, over 70% of the survey participants, they actually said that having a good returns policy is very important for them before they would do business with you. And over 80% said they want free returns. I mean, granted, nothing is free. But as a consumer, when you are buying, you want to be able to return that product if you don't like it without any hassle.
You were talking about the financial impact of these returns. What is that financial impact on a company?
So from a company standpoint, once you sell the product and it comes back, so there is a different financial impact in terms of shipping the returned product and putting it into your inventory and so forth. Today, primarily, most of the return products that come back are either goes through liquidation, which is you sell it for like pennies on the dollar, so 10 to 15 cents on the dollar, and then a ton of products are destroyed or they go to the landfill. So it's real cost to the business. What we as a company strive to do is help to solve that problem just from a financial side, is to, number one, enhance the recovery of that return item. So we can take a 5 to 15% normal liquidation returns all the way to 65 to 85% So that's an exponential improvement in your recovery, which is a direct impact to their bottom line if you're a brand or a retailer. On top of that, while you are making money, you are redirecting ton of product away from the landfill. So it's also good for the environment. So there is a definite sustainability aspect to proper returns management while you are getting financial benefit from that process. And being a CFO, I'll tell you the other very important thing that we help influence is working capital. We can free up a lot of working capital because return products come and sit in inventory. By processing them and bringing them back to the secondary market, we free up a ton of working capital, which is very important for any organization out there.
You can catch the rest of my interview with Sam Mukherjee by downloading the NYSE TV app. And coming up, TenderCare CEO joins me here in studio to take us through a personal experience inspired her to launch the company. Stick around to hear her story.
I know 100 years isn't much in the New York Stock Exchange laurels, but we're very proud. First U.S. airline to reach 100. The resilience and the determination to move forward despite all odds is something that I think we're all proud of. We've had a great opportunity to celebrate this year. The power of obsessing on our customers is what makes Delta really great. And my superpower, I'd like to think, is obsessing on them, on these people, so that they can go do the job. And it's not just me, it's our leadership team in terms of making it happen.
It's a bit of a pinch me moment. I mean, everyone's here. Here we just rung the New York Stock Exchange bell. In a lot of ways, it's a dream come true. When you walk around the NYSE floor, it's just emblematic of the American dream. Look, if I can do it, others can do it too. So believe in yourself, work hard, be the best you can be every day, and it compounds.
A plan to go and change the way people fly. It is the next step. When we look back at what we promised to go do and then we go do it, it'll be the foundation of our business that builds us to the next step. And it's because of the people here and what you all did, which was enabling greatness.
Welcome back to NYSE Live. TenderCare describes itself as the, quote, front door to elder care, a platform offering resources and support for families navigating caregiving, inspired by the founder's own experience caring for her dad. Joining me now is Shauna Sweeney. She is the founder and CEO of TenderCare. Shauna, welcome.
Thank you. So glad to be here.
So what is TenderCare and what problem is it solving?
Well, in 2013, my dad, Mike, was diagnosed with Alzheimer's. This is when I was working in tech. And because he raised me as a single parent, it was us. And I became his primary caregiver almost immediately. This was really difficult. I realized firsthand this is death by 1,000 paper cuts for any family member trying to help someone else go through the process of aging or living with an illness. I was up late at night, 2 a.m. Googles, and I realized this was so fragmented and there was an absence of technology. So TenderCare is the answer to this problem for anyone out there who's taking care of a loved one. It is the first national trusted marketplace for elder care. And we also offer a single secure place for families to get educated and get organized.
All right, so if I am using the platform, what is my experience? What is the user interface like?
First, all of our tools are totally free for families. You can come to trytendercare.com and you can just go ahead and put in Find Help. Find Help immediately brings you into an AI co-pilot intake that starts to ask you really smart questions as if it was a social worker about what's going on for your family. Every family is different. You start to answer these and we start to create a bit of a profile on what is going to be most important for you and your family for a care plan and who are the most important trusted providers in the area that are actually going to be able to step in right away and help you out.
And you mentioned that taking care of your dad, Mike, inspired you to start this platform. And I understand that the people that work for you are also caregivers to grandparents and parents. Yeah. How does that impact the business to have people that are really living this experience?
This is real. It's not theoretical. Those of us who are working on TenderCare come from all different parts of the tech sector, from healthcare. We've chosen to solve this because we recognize how broken this is within our own families. It makes the stakes very high. It also makes it very gratifying because most of us are actively living through the problems, like discharge from a hospital, a fall, what happens to make the house secure on the other side of that, as we build the products that we're making available for free to everybody else.
So that informs the business, really, because you're actually having this experience. And you mentioned artificial intelligence. How is that integrated into the platform, and what problem is that solving?
You know, I think there's a lot of focus right now on artificial intelligence being used for automation, a lot of back-end work. We're applying this technology to something much more human. How do we all support each other as we age? We all have mothers, fathers, grandparents, spouses, maybe even ourselves. And we use artificial intelligence in two key ways. The first is on intake. So really being able to quickly identify through a series of questions that increasingly narrow down what the biggest problem it is that you're currently facing. Maybe it's trying to relocate your mom from one state to the next. Maybe it's grappling with a new diagnosis, a new emergency that's landed a loved one into the ER. We use AI to be able to very quickly get to the right solution for your family. And the second is really exciting. It's around how we use all of the data that our families are trusting with Tender Care, our health information, our financial information, our legal information, to actually create an aging profile that proactively predicts how can we age better? What are the options that are ahead of you that you can now decide between in a peaceful moment rather than on the other side of a crisis?
And in our last minute together, what will growth look like for Tender Care in 2026? And what is your hope for the platform?
We're so excited about this. We're talking about an entire economy that's been largely fragmented and invisible. How do we age well at home? What I'm most excited about Tender Care right now is stitching together this fragmented economy into one simple place for families to come, find help. Instead of 6 months on the other side of a diagnosis, running around looking for answers, you immediately now, in 48 hours, have a real plan and 3 trusted providers you can immediately have show up at your door and start to help you. So we're very excited about bringing this to the public, making this available, and bringing all of the best and the most trusted providers onto our platform.
Thank you, Shauna Sweeney, founder and CEO of Tender Care, for joining us at NYSE Live.
Thanks for having me.
And thank you for your mission.
Appreciate it.
We are not going to be here on Monday. The markets are closed for President's Day, but we will see you Tuesday at 9 a.m.
Welcome to the public market.
The New York Stock Exchange is a cathedral of the capital markets. So there are a few places more fitting to consider the future of American financial system than this one.
So thrilled for this next chapter to begin today with all of you in this historic building.
The day we went public, it was the most bizarre day of my life. He said, yesterday, Shake Shack was the most beloved hamburger company in the entire country. Today, it's going to be the most reviled stock. He said, you guys are never going to grow into your $46 valuation. How many Shacks did we have 10 years ago? 31 Shacks. And did I not just hear Rob say that we're going to have 1,500 Shacks? So yes, we grew into that $46. It's all because of you guys. I'm so proud of you, every one of you. You work so hard to make so many people happy, and you make your communities better. What more could you ask for?